This is Nick here, and I'm about to go through my updated chart book on the U.S. business cycle, starting here with the leading economic indicators. So that is a monthly series measuring the year-over-year rate of change of the underlying leading economic indicators index. And the most recent reading is that the index is higher by 6.1% year over year. That's down from last report's reading of plus 6.4%. So still well above the zero line, which is the critical threshold for interpreting this chart, but it has decelerated somewhat in terms of the rate of change there. Then looking at the yield curve steepness, so this continues to flatten. It's been flattening for many years, and that continues. But it does look like if this trend continues, we could have an inverted yield curve before the end of the year, which would be significant. And that's the key threshold for interpretation on this chart, is to see that yield curve inverted. All right, moving on to U.S. PMI. So the manufacturing PMIs are the key indicator here. That's the black line, and the most recent reading at the beginning of July ticked up to 60.2. That's a very strong reading. 50 is the dividing line between expansion and contraction, and we're still up at the near the multi-decade highs here. So very strong signal there from the manufacturing PMIs. There is some relationship, I think, between the PMIs and the oil price, and we see the oil price moving to multi-year highs now, which is also typical of late cycle behavior. All right, then moving on to global manufacturing PMIs. So here we have 12 manufacturing PMIs from basically the 12 largest economies in the world, and on average, this has actually been ticked up just slightly since last month's report. But you can see there's a greater kind of dispersion here among these lines, among these countries, and we actually have two now that are below 50. So Brazil and Russia are both below the 50 reading. That's worth noting, but what would get me, I think, neutral to negative on this interpretation is to see any of China, India, Germany, or Japan go below 50. All right, then in terms of basically the unemployment momentum, so we did see the unemployment rate, the U3, tick up from 3.8% to 4.0% in the latest jobs report. That was, however, on the back of a rise in labor force participation, and so that's generally, I think, a healthy sign for the economy, although it's worth being respectful of the fact that the data does now show this gap to be decreased between the black line, which is the U3, the current U3, and the gray line, which is the 12-month moving average of the U3. The key signal here is to see crossover of that black line crossing above the gray line, and that would be negative on the back of a decline in the labor force participation rate. But I think this latest report might be reflecting the uptick in the labor force participation rate. All right, then this gray line here is a model that the San Francisco Fed developed as a leading indicator for the U3 rate. It's performed relatively well historically, and you can see there it's trending to new lows for the cycle at minus 1.28, and so that suggests that this black line, the actual U3, should continue to trend lower. So what I'm watching for here is to see if this gray line starts to trend higher. That would be a negative indication that the cycle might be in the process of turning. Then labor market capacity utilization. So basically this is the CBO, which is the Congressional Budget Office. They estimate what the natural rate of unemployment is, basically what the full employment rate is, given that there's always some sort of unemployment with just regular job turnover, but they estimate that to be about 4.6%, and we're at 4% right now. So the picture here suggests that the U.S. economy might be operating above capacity, which would be a late cycle, potentially a late cycle indicator that the business cycle is closer to the end than the beginning. Similarly to that indicator is what's called the output gap. So the CBO also estimates the potential real GDP level for the economy, and we compare that estimate to the actual real GDP level, and we can see that we're pretty much at the estimate of what is the potential real GDP of the U.S. economy. We're actually still just slightly below that, so what I'd be looking for here to tick this box in terms of confirming that we're in the late cycle or towards the end of the business cycle is to see that line cross above zero and go into the green area. Then the Atlanta Fed GDPNow, so that's remained fairly elevated through Q2. It suggests that maybe the official reading, which is represented by the black line here, might come in somewhere between 3.5% and 4%, which would be a strong growth rate for Q2. Then the delinquency rate, so we don't have an update on this data point since last month's report. The next reading will come out in late August. That'll be the Q2 reading, and in any case, what we can say is that the last data point came out positively. We're making new cycle lows in terms of the percent of household debt that's delinquent. So that's a healthy sign for the consumer and for households. So what would be the key threshold here on getting negative on this picture is to see this gray line cross above the black line. I mean, they're very close, but there's no point prejudging the data. All right, then U.S. consumer confidence, we have a couple of indexes here. They continue to trend higher on a year-over-year basis, which is generally a positive near term, although given that we're at arguably some elevated levels here, that could be sort of a more medium-term negative indicator that the economy is close to its peak and therefore possibly not far from rolling over into a business cycle downturn. The Senior Loan Officer Opinion Survey, this is an indication of the bank's lending standards, and you can see that banks are still happy to extend credit, which is generally a positive sign for the economy. This is in some ways undoing some of the work that the Fed's trying to do in terms of tightening financial conditions. What I would be looking for here to get negative is to see these lending standards start to tighten, which would be moving above zero first, and then if we get through that 20% of respondents tightening standards, that's been a pretty good recession indicator in the past. There's a little bit of a lag with this data in terms of when it comes out, but that's a good cross check to some of the other data points. A more real-time indicator, somewhat of a similar picture, is the high yield spread. This has been relatively contained, although right now we're, I'd say, at or near the 1 or 2 year highs here, so worth monitoring. But I've drawn this trend line, dotted dash trend line here, that's suggesting that at least for me the key threshold is going to be if we see that high yield spread move above 5%. That would get me negative on this picture. Then overall, here's the checklist. So most of the indicators basically still have a positive characterization. And overall, my interpretation is that short term, so within the next 6 months, I think the business cycle continues. That is with low to medium uncertainty in terms of that outlook. And medium to longer term, I'd say it's neutral. And there are a couple of indicators that I'm looking for hitting key thresholds to move that medium to longer term outlook to negative. So waiting on those signals.